Hey guys, this is Kris Jones for episode 19 of Ask Me Anything. Today we're going to chat about managing and building wealth. The idea here is to just start a conversation with you guys. I can remember as a teenager, I had a conversation with my grandfather. My grandfather Jones, now granted, he built his career in the 60s, 70s, 80s before he retired, but I'm sure he never had a year where he made over $100,000. He was successful. He was in sales for highway equipment. He was successful, but I was really intrigued by how he built so much wealth. And I knew that he wasn't making a ton of money, but here's a guy that was able to get a brand new car every 2 to 3 years for as long as I could remember. And he put my grandmother in a brand new car as well. Traveled to Florida every year for, towards the end there, once he retired, for as much as a month. And then when he passed, he left my dad enough money that my dad retired in his early 50s. So how did that happen? So I had the opportunity when my grandfather was alive for him to tell me how it happened. Him and my grandmother, they were probably married, 50 years, 40, 50 years. When they were early in their relationship and in their marriage, they both had decided to start taking 10 to 20% of each of their paychecks and just stowing it away, basically in a vault that they wouldn't touch, all with the goal of being able to retire and live comfortably. I don't think he had any grandiose visions of becoming a multimillionaire or anything like that. It was really just discipline and owning the psychology of becoming wealthy. So we're going to just open up a conversation here, inspired by my grandfather, Dick Jones, Richard Jones, my father's father. Was one of the greatest role models of my entire life. I think about him all the time. So one kind of takeaway from him was that wealth is accumulated through saving and investing, not through making money. That's an important thing for you guys to write down and think about, because what happens is you're waiting for that job where you make a ton of money so that in your mind you think, well, then I'll just start stowing some away. But if you wait too long, you're going to be behind. And there's a reason. And I'm going to get a little bit technical here, but I want you guys to start appreciating how to build wealth. That word is compounding. Compounding is a financial term related to how you let an investment or capital grow over time by collecting interest or growing its principal. So an example would be if you invested in Google, if you invested $10,000 in Google this year and it went up 20%, your principal at the end of the year would be $12,000, not $10,000. So once we start a new year, whatever growth, whatever interest you would be getting on that original investment would be on its principal. So it would compound. So year 2, you'd be starting at a $12,000 baseline, et cetera, et cetera, et cetera. The amazing thing about this concept of compounding, and by the way, it's one of the secrets to how laborers, blue-collar folks that have just grinded it out but were disciplined and saved over time have become millionaires. Those of you in northeastern Pennsylvania, we probably know someone that worked at Procter & Gamble, busted their tails for many, many years, but then to their surprise, in many cases, I know a number of guys that I went to high school with that their fathers were able to retire and the family had several $1 million to retire. But that's done through compounding. So going back to the Google example, if we just, if you extrapolate that process out, the numbers can start to get very big as your previous investment starts to provide returns. In fact, that $10,000 investment in Google this year at 20% annually for 25 years would grow to nearly $1 million. And that's without adding any money to the investment. All you need is discipline. All you need is discipline. and you need to make that first investment. One thing I did want to say, my grandfather, so he liked that I took an interest in money and an interest in building wealth. He loved it. So he would always kind of literally grab me by the ear and twist my ear or pinch me in the cheek. And we would just have these conversations about money. And I'm not going to go into details here, but one of the most awesome things he had ever recommended when I was young was, he's like, Kris, open up a Roth IRA. And the idea is that, you put in $2,000 or $3,000, anybody, by the way, any of us, it's what, $150, $200 a month of investment to max out, say, a Roth IRA or a retirement plan. And you need to start early because of this compounding effect. But with the Roth IRA, it has some restrictions based on your income and stuff like that. But the nice thing about it is that it's tax deferred. So you grow your investment over time, and then, by the way, you're taxed on the original investment. My bad. So it's not tax deferred. You pay your taxes up front on the investment, and then as it compounds, you pull it out when you retire, and the taxes are already paid. So you don't have to pay taxes on the growth of your original investment. Brilliant suggestion by Grandpa, and you guys know me. I'm very disciplined. I've been maxing out my Roth IRA for a long time. Has nothing to do with any of my entrepreneurial success. I've built wealth through simply putting in $2,000, $3,000 a year. So anyway, compounding. Next thing is this idea of managing risk. So as an investor, and we all need to become investors, you need to think through where you put this hard-earned money that you invest. And you just need to think about that. If you're, it ties into another one of the terms I wanted to mention, diversification. So when you're managing risk, you think about, not putting all of your eggs in one basket. You start to think about how you spread your investments out. And most people understand it within the stock market. So you think about, conservative blue chip investments, like IBM or Apple or some of these. You might think of, more risky investments like technology investments, like new internet IPOs. You might think of commodity investments like oil and gas and a number of other things. The bottom line is that when you make an investment, let's just use an example of $2,000 a year, and you do this at a young age. If you're younger, you may want to take more of a risk. You may want to invest in the Googles or the Facebooks because they could double or triple or quadruple. I mean, if you were able to get in on the ground floor at Google, which I think went public for $85 back in the mid 2000s, you'd be doing pretty well right now. I think it's trading at $500 or $600. Facebook has doubled or tripled. So you get it, but there's also risk there. For every Facebook and Google, there's a Twitter. You certainly wouldn't have wanted to buy in on Twitter when it was trading at 60 or 70 because it's like $15 right now. So you assess your risk, and that's really important. Again, we're all investors. You're not just listening to a guy that invests. We're all investors. We all need to take responsibility to accumulate wealth over time because remember, wealth is accumulated through saving and investing, not making money. Don't make that error. You don't have to be rich. And we all have friends who work a heck of a lot harder than we do for less money, and they got more money in their savings account and more money in their investment account. It's all about discipline and psychology. So again, diversification is just about making sure that you don't put all your eggs in one basket. The final thing I wanted to chat with you about really changed my life a couple of years ago. Not surprisingly, I love to ride the lightning. I love risk. I just love it. I like the idea of taking 100 and turning it into 1,000. That would be a 10-time return on investment. But as I got older and had kids, I have 3 children who all go to private school, I needed to get smarter about not only investing, but about managing wealth. And by wealth, listen, you're poor if you don't have any money. you're wealthy if you have enough money to do the things you want to do. In my case, I had, accumulated enough wealth that I needed to be careful that I had a nice blend of not only diversification, but I was kind of taking it to even the next level. That next level I learned through a multi-day event that I went to called Wealth Mastery. And what I learned was called asset allocation. So asset allocation changed the way I think about investing because here's the premise. The premise is that you need to take all of the money that you have or that you invest would be considered 100% of your available money or capital to invest. And then what you do is you learn about the different asset classes. I talked a little bit about that just a couple minutes ago. There's different levels of risk to those asset classes. One asset class is angel investing. And I was doing a lot of angel investing 5-6 years ago. In fact, I had a pot of cash and I was just spending it all within the angel investing bucket. Well, even though I've had quite a bit of success, quite honestly, the industry averages for an angel investment actually materializing are far less than 10%. So I was basically taking a big part of my wealth and putting it into a super, super high risk, certainly high reward, but super high risk asset class. And what I learned was that there are some things that you could do just based on math. One example was to invest in index funds. An index fund is basically investing in the whole bucket of stocks that are in one of the big stock exchanges like the S&P 500 or the NASDAQ or the Dow. And so I won't get into the specifics, but there's probably the best way to protect your investment is to go with a Vanguard ETF of the S&P 500. It's just the one mathematically. First off, the costs of getting into that electronic traded fund, that ETF, the Vanguard fund, is minimal. It's like less than 1% a year on your capital. That's what they charge you to be able to access this ETF. But it's low cost, and mathematically, it's pretty much outperformed any other asset class as it relates to just being predictable. So I learned that, and I learned that real estate, depending on where you invest in real estate, has a certain level of risk. But these things, which I also was doing, so I like to invest in the stock market, not only angel invest. I own a bunch of properties, and I invest in real estate with my brother Rick. So here's the point of this: is that I had this pie chart. The entire pie. By the way, you have a pie chart too. Our entire pie is 100%. If we carve out pieces, those pieces represent a percentage of the overall allocation of assets. And guess what I was doing? I had 95% in angel investing. Not smart. So what I did is I really thought through, how I, at that stage of my life, and I really haven't modified it too much since, but at that stage of my life, a couple years ago, what was the appropriate asset allocation? And I said, about 65% of this capital that I have really needs to almost be untouchable, meaning that I'll be okay with protecting the downside, meaning like I don't want any downside, and then having, meaningful but not huge upside. So I'm not going to get a 10-timer on 65% of my assets, but I would be happy with, say, 3 to 5% or 5 to 7%. And I would particularly exchange that to mitigate my downside risk. And then I said, oh yeah, I've got 35% here that I could play with. And then I said, not so quick. That's too much. So I took about 20% of that and I said real estate. So on any given, month or quarter or year, I'm willing to spend up to 20% of the capital that I have available on real estate. And that's pretty much the stuff that I do with my brother Rick. But then I had that 15%. So, I'll make calculated high-risk investments, angel investments, among other things, but only risking 15% of my total asset availability. 15% of that pie chart. So it's a smaller piece of the pie, whereas the 65% is being protected. Now, your asset allocation might be different based on your age, among other things, and I hope this idea of managing risk and diversification and the power of compounding helps you start to think through this. For those of you that are actively taking advantage of either stowing away money every year, you love the power of compounding, share your story in the comments. Give me some advice or provide some advice or reflection to the viewers of this video. This, guys, is a very, very important thing. You've got to stop thinking that you're going to wait to invest until you start making a certain amount of money. That's just garbage. I told you, my grandfather inspired me to do this particular Ask Me Anything. And I just listened, Pop, so how did you, you get a new car every 2 to 3 years. It's not like the guy works 9 to 5. He's coming home. How did you do this? Beautiful home in 44, and he did it through discipline and through this concept of compounding. And through mitigating risk and thinking through how to and discipline and thinking through how to accumulate wealth over time. And I hope that this video inspires you to do the same thing. If you aren't doing it, you need to start doing it now, because you're an investor, whether or not you think about it or not. You're either investing 0% in your future or you're investing in your future. Hope you guys found this video useful. I can't wait. I cannot wait for video 20, because video 20 is going to be a milestone here in these 100 videos that I'm going to do. I haven't quite decided finally what I'm going to do, but it's going to be different than just me sitting here talking to you. I don't know if we're going to go to a different environment. I don't know if I'm going to bring on a special guest. If any of you guys have any ideas, and you could intercept me between when you see this video and just a day or two, give me some ideas. And if you don't, we'll have episode 30, 40, 50, and then the Grand Poopah, where I'm going to sit down with President Trump on video 100. Kidding. No, I'm not. Peace. See you guys soon.